In the trailing 12 months ended the middle of this year, large bankruptcy filings numbered 117. That is 50%, nearly 50% above the 20-year average. But for the people on this stage, there's a much more interesting figure, and that is this. More than 8 out of 10 venture-backed companies will not make it to their 5th year. And for them, the federal bankruptcy process is almost never the right tool. So how do you engineer a soft landing? I am David Johnson of Resolution Financial Advisors, a firm specializing exclusively in end-of-life cycle companies. With me here on the stage is 𝐒𝐭𝐚𝐫𝐿, Regional Manager of Silicon Valley Bank in New York and a longtime workout partner. I have Aaron Schwartz, an independent director who is often parachuted in at the direst moments. And at the end is Matt Thompson of Skyview Capital, who is long experience in investing in distressed situations. He and I share a background at Alvarez & Marsal many years ago. He's also worked at the Gores Group doing acquisitions and also directly in tech at Amazon Web Services. So we've got the whole chain of the distressed process here on the stage. So I want to start with Claudia and ask her, as the lender in many of these venture-backed situations, Silicon Valley Bank is a venture lender, of course. What do you, Claudia, do to ring the alarm bell? What triggers your concerns about loans? How do they wind up in the troubled loan division? And specifically, what technology or maybe even artificial intelligence is coming into play with those decisions these days?
Very simple question, but it's kind of a complex answer. As you know, we're as bankers, when we put the deal in place, there's a series of processes that we follow in order to do our portfolio management. And we monitor different things like the broad economy, like the tariffs. How is that affecting each of our different industries that we lend into? We also monitor the revenue, how much is each of the companies investing in to get that revenue. But the one, I would say, the one factor that we monitor closely is the liquidity, cash, and then what runway does that provide the company to get to the next round of equity? Because a lot of our companies are still burning money, they're not making any money. So we need to understand how much runway do they have to get to the next one. It usually, if a company and a lot of these factors are going in the negative direction for our borrowers, then when it gets to about 90 days of liquidity, that's when it transfers over to advisory services. That's the group that I work with. Instead of a workout, we're a friendly bank, so we call ourselves advisory services. So it transfers over to our team, and we start very closely, talking to the board, talking to the management team. What are the next steps that they need to do? What is the board monitoring? What KPIs are they monitoring that will get the company to the next round of equity? And usually, that is when advisory services comes in, has a little bit more what we call the pointed questions to the board. Instead of talking to the board maybe once a quarter, we talk to the board once a month, a lot of the times a lot more than that. But that's essentially, I wouldn't call it sounding the alarming bells, but trying to figure out what are the next steps for the company to get to the next round of equity.
And you might have some strong advice for them, such as bringing in an advisory firm or perhaps appointing an independent director to the board. This is where Aaron comes in. Aaron, tell us when are you brought into a situation by a lender or equity or the board? How does it happen and when does it happen?
So very nice to be here today. Look, I think all these circumstances obviously have unique characteristics, and when someone hits the alarm bell, and with how much advanced warning there is, certainly varies from circumstance to circumstance. But generally speaking, people start to think about it at the point that either the liquidity is drying up in the business or the results of the business are actually deteriorating. And that is sufficient in the case of levered businesses to trigger the prospect of a covenant default. And so then the question is, well, why does someone bring in an independent director? And I think the answer is manyfold. One, often boards are constructed with an eye towards who will lend relationships that are useful to the growth of the business. At the point in time when a business starts to become distressed, the need on the board is for someone who can assist with disciplined financial management, understands the process for mitigating the risks to the company, and how to ultimately maximize the value of a business that is otherwise on the wrong trajectory. And so lenders will often designate a director once there is a default. Sometimes it is the founders who will bring in a director to help them try to hold on to their business. And then often as well, you'll see institutional investors who were sitting on boards decide that they want to step away. And one of the big advantages, of course, of being an independent director is you get the benefit of the doubt under the law. It's something called reasonable business judgment, as opposed to the entire fairness standard that applies to interested directors. And that gives a director more flexibility to make decisions and frankly, under the, in the eyes of the court, a presumption that the decisions being made are right for the business and not being evaluated necessarily just on the outcomes of those decisions.
Thank you, Aaron. I'm going to go out of order just a moment to say that the next step might be, as it has been in multiple cases with Aaron and I, that he brings in a firm such as Resolution to explain alternatives. Again, we do some bankruptcy work. Bankruptcy is a great tool in certain circumstances, but it is overkill, expensive, and unduly complicated in many circumstances. So we'll map out what the alternatives are, alternatives to bankruptcy, whether that's a receivership or a foreclosure by a lender or an assignment for the benefit of creditors, which we spend a lot of time doing. So Aaron will bring me in. One of the things that we'll do is we will shop the company's assets in a parallel process. We'll run a mini investment banking process where a full investment banking process may have already been tried, but now we're having a different conversation. And that's when I'll turn to somebody like Matt Thompson here and SkyView, who are experienced in looking at distressed situations, who are looking at asset sales rather than equity purchases, who understand what questions to ask and what to think about. So let me ask Matt directly. Matt, what do you look for? What will you consider? What are the key metrics, perhaps? What kind of things scare you away, and what kind of things don't scare you away?
Hello, great being here today. So throughout my career, I've looked at a lot of distressed businesses, and we've bought things out of bankruptcy, bought them through ABCs, and also Article 9 situations. And as Nouriel Roubini was mentioning, the economies are very cyclical, and you see these patterns, that the railroad boom, the railroad bust, the telecom boom, the telecom bust. We're probably going to see an AI boom and an AI bust. But through those cycles, great companies are formed. Right now, there's hundreds or thousands of AI companies. Those companies, some of them are going to create great technologies. Some of them will go out of business, but all of that growth and investment is the railroad tracks of the future that are being laid and being consolidated. So we see a great opportunity in buying these assets after they lost some of that overhype and the ability to buy them in more reasonable valuations and then turn them around and then perhaps be the facilitator to get them to a more normal sale path. So we work with companies when we hear about these situations, like from a Resolution or a Sherwood, and we hear about these opportunities to perhaps buy these businesses or buy the assets and then restart them. We've done a lot of work with carve-outs where we will buy pieces of businesses. And these are opportunities that are not normal sale processes. We're buying it without management, without some technology, without HR departments, and we're rebuilding the companies around that or rebuilding a company around an ABC. But if you're willing to put in the hard work to stabilize these businesses, build them up and carve them out, there's amazing returns. Sometimes you can buy these assets for near zero, things that were trading at hundreds of millions of dollars or billions of dollars just a couple years prior. You can buy them for pennies on the dollar and then stabilize it and get great returns. And the things we look for are situations where there's a core business that can be saved. There's something of intrinsic value. It's not just a falling knife.
Do you have any examples, Matt? Any war stories you can give us of a recent transaction?
We've definitely looked at hundreds of carve-out and distress situations, but some that come to mind. We bought a business, which was a great software business that had been around for a while. It was not necessarily the highest flyer in the space, but it was bought by VMware, which was now EMC. This business languished within EMC because it was sort of cannibalizing some of their existing business, and it was a little lower growth. So they had become an orphan division within VMware. They wanted to sell it. We were able to buy it at a very distressed valuation. We were then able to put in new management, build middle management around it, rebrand the business while keeping the customer base intact. Then we were able to take that business, and then within a period of 2 years, we were able to sell it for a great return.
Thank you, Matt. And it's the case, I tell my clients all the time, just because a company could not make it as a going concern doesn't mean that there's no value. There may be in-house software that was developed, certainly patent portfolios, all sorts of trade secrets that have been developed. They may have some value, and that's what Claudia is relying on, because she's going to try to recover something, even if that next round of capital hasn't come in, even if there's no sale of the company, she's still looking to get paid back on her loan in full or in part. And so our firm and the partnership up here on the table, on the stage, is focused on sussing out whatever value can be done, making sure that every option has been explored, and hopefully the bank gets paid. That's kind of my benchmark. Try to get the secured creditor paid, and if there's money left over for unsecured creditors, so much the better. But Claudia, as a bank, you've got a big stick, and that is the threat of foreclosure. But I don't sense that that's a great solution for you most of the time. So what do you like to see happen when there's been an investment banking process run and there's no buyer, when that equity sponsor is not going to put in any more money? What kind of solutions do you look to try to get repaid?
Typically, our clients don't have enough capital, as we spoke about, and I think it's a common theme among my panel partners here that liquidity is key. And for venture debt or venture backed companies, they don't have a lot of access to liquidity. So a Chapter 11 is not something that they can afford to do. So typically what we see is partnering with somebody like Resolution Partners that will do that ABC process, the assignment for the benefit of creditors, where we typically engage with David or one of his partners, one of his colleagues, and they will, on behalf of the secured lender, senior secured lender, they will go out and try to liquidate all the assets for the majority of for the most recovery that we can get. One key aspect for us is that as the company is having lower liquidity, typically there will be an ask whether there is a covenant default, whether there's something that they need us to waive or work through. And at that point, we do take advantage of the situation, and we will ask for a lien on the IP, on the intellectual property. And as David said, a lot of the times the physical assets that the company has will give us some return, but the biggest return will come from trying to selling that IP, which we've been fortunate to get significant proceeds from.
And again, a word about foreclosures. Again, it's the big elephant in the room, but do you ever execute on a foreclosure? Do you exercise your rights and take the collateral?
I've been in this role for maybe, I've been at the bank for over 20 years, but in this role, I've been here for maybe three years. And in my tenure, I have not exercised foreclosure. I haven't taken over, as the company says, here are the keys. We don't do that. We are another party, I would say, another vendor. So the board and the management team is the one that needs to make those decisions. But rarely do we come in and we exercise those rights. I would also say receivership is another topic that I think David brought up. Have not gone through that extent yet. It's a long process. The courts are involved. But having said that, foreclosure, I don't think any of my colleagues at SVB have exercised that. Maybe it's the very rare occasion that we do it, but receiverships is something that we have moved forward with. And that's something where the court is involved. There's somebody like an assignee of an ABC process that takes over and liquidates the assets.
We recommend a receivership when the lenders or even the board, frankly, has lost faith in management and they're looking for adult supervision. But again, that's Aaron's role. Aaron comes in as a voice of reason, an outsider. Aaron, when you come in, what is your mandate? What are you typically trying to do and in what time period?
So actually, I'd love to just very quickly pick up on something both Matt and Claudia spoke to. Matt talked about opportunities that arise to buy businesses for virtually nothing. That is a failure of a group of directors if that happens, right? Because what has essentially happened is the company has died. And it has died because it ran out of liquidity. You can go a very long time with negative earnings. You can go a very long time without sales, but you cannot go a long time without liquidity. And so boards, that is the vital metric to be watching in most companies, and it is what should be triggering actions. What Claudia is referring to and being in a position where she is not exercising foreclosure, that is a reflection, presumably, of boards that are being responsive to, clear about their fiduciary duties, responsive to the concerns of their lenders, and trying to maximize value. So when I get onto a board, often that is a reflection of the fact that there has been a crisis of confidence as well as a crisis of liquidity. And so one of the very first things I need to do is to establish a rapport with the key stakeholders. And by that, I mean the most senior lenders to the business, but also the equity holders who maybe have lost faith and lost confidence in the business and therefore are not opening up their wallets to continue investing in the business. It's sort of a softer piece. The harder science piece of it is to get your arms around the runway that the company does in fact have, where it is spending its money, and start making some decisions about what are and what are not prudent investments that the business is making, and figure out where there might be sources of incremental liquidity to keep lengthening out that runway and give enough time for the business to turn. The third piece is clearly talent and the question of whether you have the right people in the right positions at the company. So if you buy more time, but you still have the wrong people, those pilots are still not going to get the plane to fly, right? And so being able to quickly assess that and bring in the right people. And then fourth, obviously, is when you determine that there isn't an internal solution, quickly moving to some sort of process to effectuate a sale of some or all of the assets of the business. And that's where David's group comes in. And, like in most things, the more time you have to do something, the better shot you're going to have a successful outcome. So alacrity and speed with which you make those types of decisions are pretty critical. And, I think at the end of the day, one of the big reasons why people put independent directors like myself in those positions.
Extending the runway is vital, as Matt can attest. You often don't have months of cash flow left. You may only have weeks. So Matt, talk about that. How quickly can you move? What do you need to do to get in a position to make even an initial offer when you don't have 6 months to diligence a company?
So in a lot of these situations, it is very short fuse. So what a lot of it is being able to figure out the large areas to diligence and quickly focusing on those. Like I said, a lot of these situations, it's going to come with a very lean management team. So we really have to diligence management. Can they right size this business and get it to back on track? One thing we've really emphasized recently is starting to use AI tools. AI is the hot topic. It's very useful for diligence. It's very useful for some of the mundane tasks that typically you would need a sea of analysts to do. You can just put all the contracts in a SharePoint and just say, co-pilot, summarize these, which ones have non-assignment clauses. You couldn't do that before. You would need like teams of attorneys getting $1,000 an hour to do that. Now you can do that in 15 minutes. So that's changing the dynamics. But you still need to have the rational skill set, understanding the fundamental economics of the business, and figuring out what you can do to save the business. Now, in these situations where it's a very short fuse, sometimes we'll have weeks to do diligence. So you have to focus on the key points. And because typically the transaction values are so low, you're taking that risk. When you're buying something for a fraction of asset liquidation value or a fraction of what the revenue was last year, you can afford to take that risk and perhaps not dot all the T's and I's that you would in a normal transaction.
Thank you, Matt. One of the things that I want to spend just a minute on, since we have some time, is the method that these companies are going through to both monetize their assets and to do the administrative wind down of the show. Because remember, these will be asset sales. We're going to assume for most of these cases that equity is out of the money. We're going to just try to do the best we can to get recovery for the debt, starting with the senior secured debt and then the trade creditors. Again, we do some bankruptcy work, but now you're in front of a court. You're subject to their timeline, their expenses. You might have an unsecured creditors committee. If we can find an alternative to that, that's a much better option in most cases. And most of these venture-backed companies we're dealing with are not going to be restructured. They're not going to be sold in a way that has to be done through a Chapter 11 process. So we'll use this term again, assignment for the benefit of creditors, or ABC for short, that many of you may have heard about. Is becoming much more prominent as a way to wind down a company. And ABC is not done under federal bankruptcy law. It's done under state law in California or Delaware, New Jersey. Various states have various statutes. Some have unfavorable statutes like New York. But we often can find a jurisdiction where a company will contract with a private trustee, or assignee as they're called, to do essentially the job of a Chapter 7 bankruptcy trustee. But here the company gets to choose its own trustee. You're not assigned a random one. And it's often someone like my firm Resolution who has experience in monetizing esoteric assets. So we could come in on a very cost-controlled basis with a fixed budget and a glide path to not only monetizing the assets, but actually taking over for the board, who's then permitted to resign, and doing the administrative wind down, taking care of the creditors and the employees and the record storage and the tax returns, and in a very, very efficient way, provide a soft landing for the company itself, a response to creditors, and at the same time, recovering whatever value we can recover for the lenders. So it's something that I think everybody should be considering, as bankruptcy is cumbersome and more expensive. That this is an alternative, along with the receivership, along with the foreclosures, which we also do on behalf of venture lenders. We act as a foreclosure agent.
Can I add one other thing, which I think is a major advantage of an ABC? Oftentimes, you have people who have lost a lot of money in these situations, who have platinum reputations, and they are concerned about their reputations. And so a huge advantage of an ABC as well is that it is really a quasi-private transaction. You're not making public filings as you would be in a Chapter 7 or a Chapter 11. So not only is there an economy of process as well as an economy of dollars, but there is also, I would say, an economy of publicity. And so what that allows is for people to make tougher decisions quicker without the embarrassment, so to speak, of having those decisions be reported publicly.
And Matt, you've purchased companies or assets rather through ABCs. What has your experience been like?
We think it's a really interesting situation. Sometimes there'll be a unicorn, and it's 5 years ago it had no revenue, it had no customers, it had no employees. Today it has maybe 10 million of ARR. It has patents as a team, but the venture lender is tired. The VC is past its fun life, and it's not a unicorn anymore, but it's still a great business, and they just turn over the keys. So it's an opportunity to come in and then buy this smaller business with all these great capabilities, the patents, the trade name, the customer list, and then start it again from this very low basis. So we find them very interesting opportunities, and you can buy it debt-free. So it gives you a chance to take a swing at a unicorn prospect with a pennies on the dollar purchase price.
Debt-free is a good point. Yes, when you buy the assets, you've got a brand new clean balance sheet. And Claudia, I know that an ABC has been a go-to solution for Silicon Valley Bank for many years. We talked about foreclosure a few minutes ago. Certainly the bank doesn't want to own operating assets. So tell us why this has worked out for the bank.
I think it was Matt who said it's one of the ways to maximize return for the assets that we have. Understanding that for venture-backed companies, the biggest asset a lot of the times is cash. And at this point, they don't have a lot of cash to continue to work through whether it's continuing to sell the product or continuing to make the product. So a foreclosure would mean we have to come in, we have to see what we're going to do. But working in an ABC process, we have the opportunity to sell the customer list, maybe to somebody like Matt, who mentioned, that's something key that he wants to see, and then just maximizing the return for the loan that we made, maximizing the return from the assets.
And unlike a foreclosure, in the early days of an ABC, the assignee can actually continue to run the company, keep the ball in the air for some period of time while we seek a buyer. So therefore, we're selling assets, but in a sense, it's a going concern sale.
Well, we just did one of those with you, where we ran the business for over 4 months.
Tell us about it, Aaron.
In an ABC. The world really did not know that we were in an ABC. Creditors did, because we needed to give them certain notices. But the average customer did not. It was a consumer-facing business. And so we were able to sell off the company's inventory at very attractive gross margins, because the world as a whole did not know we were liquidating until literally the last couple of weeks. And so that maximized the proceeds. It allowed lenders to get paid back far more than they otherwise would have. It allowed us to keep the employees stable at the company while also honoring our obligations under WARN and other applicable law, and ultimately to preserve a lot of the brand value, such that at the end of that process, it was not so damaged that we wouldn't be able to sell the brand and help that business get restarted. And it's an interesting thing, because the management team in that business has, the opportunity now to rebuild the business without all of the legacy mistakes that had been made by their predecessors, and without all the legacy expensive infrastructure. So they are now in the process of rebuilding the business with their partners, using the state-of-the-art technology and the best available means to operate that business. And so this business, I think, is going to thrive in a way that it was not able to do so before the ABC.
And from a lender's perspective, although they'll take a haircut, they received a lot of cash up front over the last 4 months, as you said, but will also benefit from 𝐒𝐞𝐞, which will pay them an earnout over time. So
correct.
A lot of brand value recovery still exists there. All right, we've got about 5 minutes left, so we do have some time for questions if anybody wants to ask. Otherwise, we'll wrap up just a few minutes early. Yes, here.
Have you ever dealt with fraud?
Unfortunately, yes.
The question is, have we ever dealt with fraud in these situations?
Yeah. So, look, the reason fraud exists, or really, I guess the most pernicious aspect of fraud, is that it delays recognition of an underlying rot or problem in a business until it reaches crisis. And one of, I have many sort of sayings, but one of those sayings is that no crisis, it happens overnight. They all take lots and lots of time to develop. And so tell me early, tell me true is one of the things I say to management teams. Let's start working on the problems before they become crises. In a fraud, for whatever the reason, that management team has decided to obscure the problems in the business until the point at which they become completely uncontainable. And so when you have fraud, it is a very difficult situation because, number one, the problem has advanced way further than it otherwise would have been able to advance. Number two, people's confidence, your capital partners' confidence, is deeply shaken. It's not just losing confidence in the wisdom of the business or the strategy. It is a loss of confidence around all the people. And those are very, very difficult situations. They are inherently very unstable situations. If they, which is usually the case, they coincide with a loss of liquidity, those are usually life-ending.
Hit that nail on the head there, exactly. I've been doing this more than 20 years, and surprisingly few incidents of fraud, actually. Maybe it's the client base with which I deal. But I do have one story that I want to talk about very quickly. I was called by a board of directors one time a couple of years ago. They said, we just found out we have no cash. The CEO's been lying to us, and we need to shut this thing down immediately. Well, it turns out there was a deal on the table for a buyer, a Fortune 500 company, to buy this company for $50 million. And the CEO was trying to extend the runway. So he was going to payday lenders, essentially, the hard money lenders that are so prevalent today, and borrowing money, $250,000 at a time, week to week, to meet payroll, without telling the board. He insisted that that was his threshold of borrowing without permission. So he had racked up 8 or 10 of these and couldn't get the deal across the finish line in time, and eventually it caught up with him and it crashed. So the board decided to terminate everybody immediately, stop the burn, and essentially they had zero cash. They brought us in. We became the assignee. Now, we did run a sale process very quickly for the technology. And it turns out that this Fortune 500 company was actually pleased to buy the technology and didn't as much care about the team. So they were still at the table. We ultimately came back with them and they said, well, we're not going to pay $50 million anymore, but we'll pay 15 for the technology since it's so broken. So we did that deal. The buyer was thrilled to be able to get such a large discount. The technology and indeed the brand name lived on. And that $15 million was enough to repay the senior secured lender in full. That was a great outcome, at least for the debt holders. Certainly equity was out of the money, as we said, but it was a way to resurrect the transaction without going through months and months of a bankruptcy court, resurrecting a deal, albeit at a discount, that allowed certain assets to live on and value to be gotten out of the transaction. And that lender is a good partner of mine today. So that was a great outcome. But that was probably the closest thing I've come to fraud. But it happens. People try to extend the runway. They get scared, and bad things happen. What?
Yeah, maybe not really fraud, but obscure truth. And that's another factor that we pay close attention to, particularly with the AP and how stretched AP vendors may have gotten. I got into a situation where I'm the secured lender, senior secured lender. There is a subordinated lender behind us. But the AP, who's unsecured, they had one particular vendor had not gotten paid for maybe over 4 months or 6 months, if I remember correctly. They were able to go to court, get my company at the time when I got involved, they still had 4 months of runway. And this vendor came in, went to court, they got a writ of attachment, which froze all of the accounts at SVB. Now the client doesn't have access. The 4 months that they had no longer exist. And we were able to work with a subordinated lender, extend a little bit of runway. Both of our notes got acquired by another third party, but it's not necessarily, like I said, a fraud, but it's just obscure truth sometimes.
And this is something, Matt, you've got a very short window to try to assess as you make your decisions.
It's obviously something we want to avoid, but we have found that sometimes a fraud will lead to a distress situation, which we can then buy and then fix the situation.
All right, see, our time is up. So unless there are any other questions, we'll move on. Thank you, everybody, for your attention.